Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. In today's video, as the thumbnail and the title would suggest, we're going to be looking at super investors, and we're going to be looking at what super investors have purchased as the recent 13F filings of all the big hedge fund managers have came in. We're not going to look at all of them because I don't think there's much value in looking at all of them. The ones that I'm thinking of looking at is first and foremost Bill Ackman, because I think he's someone that I admire very much. I look at his portfolio trades, I respect him very much, I look at his interviews and that type of stuff. And actually, he recently bought into Uber, which, if you're a regular viewer of the channel, you would know I've been highly bullish on Uber for the past couple months, really since September. I've kind of looked at it and been interested in this business. I really started to ramp up my purchases in December and, talking about it in December and that type of stuff. Maybe later on in the video, we'll watch a couple clips of me talking about Uber and that type of stuff. We'll see. But yeah, first, I'm thinking of looking at Bill Ackman. Then, of course, I'm going to look at Kantesaria because, again, I would just, in terms of influences on me personally and my investment style, I would put those two as the top two investors that I kind of look up to. I think we'll very briefly look at Buffett and what he did. Terry Smith, same story. And then perhaps most compelling out of them, I would say Polen Capital, which is, one of the biggest hedge funds. Actually, I'm not sure if we call them a hedge fund, but one of the biggest fund managers is Polen Capital. And so we'll take a look there. Very interesting, the sort of strategy that they're taking over there and that type of stuff. So we'll get into all that. First and foremost, of course, and I think we'll probably spend the most of our time here on Bill Ackman. Everything's timestamped at the bottom, by the way, so you could feel free to skip around if you like. But of course, he came on February 7th, which I believe was about a little over a week ago. He came on and said that he had purchased 30.3 million shares of Uber. Keep that number in mind because we'll come back to it a little bit later on. I think it comes out to either his biggest position or roughly his biggest position. Long-term admirer of Uber and Dara, customer-centric, blah, 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 whatever. Here he talks about how it's a great business. Uber suffered from erratic management since he joined the company. Dara Khosrowshahi, the CEO, has done a superb job in transforming the company into a highly profitable and cash-generative growth machine. We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased, and this is the key right here, it can still be purchased at a massive discount to its intrinsic value. I fully agree. This favorable combination of attributes is extremely rare, particularly for a large cap company. We will have more to share about our thinking on the company shortly, and we'll go take a look at his investor slide deck of how remarkable that was, his analysis on the business. But I completely agree. I think Dara is, maybe we'll do a video on this eventually as well, of ranking the CEOs of companies. I would put Dara right up there. I would put Dara right up there as the S tier. I would put him right next to Satya Nadella. I would put him right next to Tim Cook. I would say, honestly, maybe Andy Jassy's a tier below him just because he's kind of unproven at the moment. He hasn't been CEO for a long time, right? So, I would put him the top of the top in terms of CEOs that gets it, knows the business side of things, can execute, sells you the dream, could really push the direction of the company. And, in terms of just pure amount of challenges that he has faced as in his very short tenure since 2017, it's not been that long that he's been CEO, but, obviously coming in, and Uber was facing a plethora of challenges with Delete Uber and the corporate side of things, that they were facing mismanagement, Travis Kalanick and all those issues, the C-suite, the allegations there and that type of stuff, right? So all these different challenges, he navigated through that, turned on the profitability button, really amplified that through the pandemic period. Obviously, that was a big challenge in of itself, having 80% of your revenues disappear overnight. Definitely has faced his fair share of challenges and has done a wonderful job navigating that. Again, incredible CEO, but I digress. With that being said, to actually look at Bill Ackman's portfolio, we're going to go over to this beautiful website, finchat.io, and a little known fact is that you can actually search up, super investor names on here. You guys see me use this all the time, but as you can see, we do have super investor data in here loaded, good to go. Now, this is as of year end, and what you'll notice is that Bill Ackman said that he started buying it in early January, and this version of the portfolio is of December 31st. So we don't actually see the Uber purchase because it was off by maybe like a week or two that they actually made that decision. So we're going to have to wait another 90 days to actually see the 13F for when he actually purchased into Uber. But with that being said, in terms of his portfolio, I think he has a very high quality concentrated set of businesses that Bill Ackman invests in. In terms of actual moves, he sold a little bit of Chipotle, which shouldn't really surprise anyone. He's owned Chipotle for so long. I think it's close to a 10 bagger for him. And he's definitely maybe taking a little bit of gains off, especially because, the valuation has ran up exponentially, right? Like I think at some point it was like a 70, 80 trailing PE in terms of, and I think he probably used some of those gains to fund the Uber purchase. He bumped up Brookfield a little bit more as well. Brookfield, he's been adding to it recently. And actually another thing we could do is we go into the companies here. And if we just find Brookfield, Brookfield right there, you'll see that, it's been a couple quarters that he had purchased it. So initially put like a little watcher, 2-3% position, bumped it up even more to a very sizable 14%. And then now, today, it makes up, well, as of December 31st, it had made up about 16% of his portfolio, which on paper, that shows up as the biggest. But I think because he has Google at a 6% and a 11.4%. So the Google position combined is still about a 17% position for him, but it's split between the two tickers. I'm not sure why. Anyhow, QSR also held that for a long time. He bought a little bit more into Nike, which I'm honestly kind of torn on Nike. Like at the same time, like I do get it. Like I think, maybe we'll pull up the financials here just to kind of showcase this. But yeah, if we pull up Nike, the big thing and the big mistake that investors make is they're looking at it here like, oh, it's only a 23 trailing PE. Like it's not even that cheap, right? The issue with that is that you're looking at it on depressed earnings, right? So the best way I could kind of showcase this to you is if we pull up the net profit margins. And so what you'll see is in the 2021-22 period, they kind of peaked out their net margins at like 13%-ish. And then now, over the past couple of years, net margins have declined as a result of, all the challenges that business is facing with their inventory and supply chain issues and so on and so forth, right? And so as a result of that, the PE looks optically a little bit more on the expensive side for a business that, I think at this point is down like 60% or something ridiculous. Let's take a peek. If we just click on the drawdowns feature. Yeah, anyways, it seems to be about like a 60% drawdown in the stock, which just, for a 60% drawdown, how's the PE still at a 20? How does that even make sense, right? And again, it's because of these net profit margin declines that these are depressed earnings that you're kind of valuing the business off of. So I think the more accurate, take that with a grain of salt, but the more accurate way to kind of look at things is the price of sales, right? And so when you pull up the price of sales, which isn't exactly the best proxy for profitability or Nike's valuation as a whole, but gets the job done here, you'll see that it's actually hovering around the lowest price to sales that this business has traded at in the past, call it decade or so, right? So we're actually below the 2020 lows in terms of price to sales. That's how cheap this business has gotten. We're about there, right? Like we're hovering around the 2 times price to sales, give or take. In the peak 2021 period, it was 3 times higher at 6 times price to sales. And I think this does a better job of sort of representing how cheap the business actually has gotten. So another thing that we could do is kind of optimize for if this business was trading at 13% earnings per share, 13%, net profit margin. So it's a $49 billion revenue business. And so that would land you at about $6.4 billion of net income compared to the 4.9 that it is at currently. That would mean that, with a roughly $108 billion market cap, the earnings sort of optimized for 13% net income margins would actually be closer to like a 17 PE, right? Assuming that they're able to reach that eventually, it's technically at a 17 PE is kind of what I'm trying to get across. Anyhow, I think it's a decent bet. I'm personally not buying just because I don't like to buy apparel companies in general. They're way too unpredictable for me personally, but I could definitely see like he's going to buy into this. It's going to turn around, especially with his reputation. This is very much his style of investing and his style of companies to buy into. Buys into it, the sentiment kind of changes on the company. He makes a double and moves out of the business, right? Like he's done that repeatedly over and over again. Maybe he holds on for a couple of years, whatever the case is, massively outperforms, and that's it. With that being said, the next up, we're actually, let's save Kantesaria. So let's do Buffett first, right? So if we pull up Warren Buffett and look at his holdings recently, and I don't get it, man. Like you see this time and time again with Buffett, where like, for example, he buys into TSM and then sells out 1 quarter later, buys into Alta, sells out a quarter later, right? Like at this point, it's not even him that is actually making these buy decisions. It's probably the lieutenants and that type of stuff. It doesn't really mean anything, right? Like he buys into these companies at like 0.2% weighting and the stock moves 10-15%. It just doesn't make sense to me. With that being said, the stuff that is interesting to me is like, for example, he sold Bank of America 15%. And this is continuous trimming in terms of Bank of America, right? So when you look at this, like over the past 2 quarters, he had over 1 billion shares of B of A, and now he has roughly 70% of that. So a little bit less than 70% of that. So he's sold about 30% of his B of A shares for like the first time ever. And like that is very interesting to me, where like I would assume when it's that significant portion of the portfolio, Buffett is the one actually calling to make that change. And so I would follow that closely. Maybe he thinks banks are a little bit expensive. So if we, for example, just pull up B of A, and of course banks are valued on price to book. So we pull up, the price to book of this business, you'll see that like, yeah, in the past, give or take year and a little bit, it has rallied quite a bit in terms of price to book, going from roughly 1.8 times. And actually, I need this like this. Here we go. Yeah, it's gone from about 1.8 price to book to 1.3. And like it's a little bit more on the expensive side, particularly looking at the past decade or so. But at the same time, like, I don't know, if I was a B of A investor, I'm definitely on the more expensive side, but I wouldn't read this as like he knows something. You know what I mean? And so going back to it, like that was definitely an interesting trade to me. In terms of other purchases, he continues to buy Oxy, and like he's very under the water with that. SiriusXM, no idea. I personally wouldn't follow him into that. It's very much a dying business. Constellation Brands, I'm not very much familiar with. Domino's, he bumped up. That one is pretty interesting. More selling in terms of the banks. And then he bumped up Pool Corp by 50. Again, like this is like 0.1%, like negligible impact in terms of the actual portfolio. So just now, by the way, if you guys didn't know, under resources and super investors, you'll be able to kind of view all the super investors available on the site to kind of track. I was just going through it. I was thinking of going through Chuck Hockery's, but honestly, not really worth it. I think we'll do Terry Smith in a second, but another kind of like bonus one that I kind of wanted to briefly talk about is Chris Hohn, which he runs also like one of the biggest funds here in terms of all the super investors we're kind of watching. In his portfolio, I admire very much because A, massive concentration, and B, he kind of likes to buy these businesses that I also like. It's a little bit more like big tech tilt. So he's got his Alphabet, Microsoft. I believe he had Amazon at one point in here as well. I think he recently sold it. Obviously I'm a fan of the S&P Globals, the Moody's, the Visas of the world. He has railroads in there, which like overall, like I like his portfolio. These are kind of the type of businesses, the quality businesses that I like to invest in as well, or at least in my investable universe. The only thing I want to highlight is that he was buying Microsoft. And his history with Microsoft is a very interesting one because it used to be a massive component of his portfolio in Q4 of 2022. For reference, Microsoft was like below $300. I think it was like around $250 a share. And he had sold a little bit, and he sold a little bit more. And like he continued to sell in terms of share count. He went from 22 million shares all the way down to, he halved this position essentially. Obviously he's taking in capital into the business and the stock is racing higher and higher. So it's a very interesting sort of perspective that when the stock was so cheap back then, and I'll kind of be able to demonstrate this to you as well. If we pull up Microsoft, and for simplicity's sake, I think we'll just look at forward earnings. So forward PE, and we'll toggle this on. Let's just move it to like, I don't know, the past 5-ish years, right? So he was selling his position around here between let's just call it like a 23 to like a, yeah, like roughly like a 23, 26 PE-ish, give or take. He was selling his position here, and then he sold a little bit more in the quarter following that, which like, it did get a little bit more expensive, 27, 28 PE, whatever. But then he bought it back in the most recent quarter, and he was buying back at probably like an average around like a 30 times earnings multiple that he bought back into the company. So very interesting sort of thing where he was selling he sold half of his shares at probably like a 23, 24 earnings multiple, and then he's buying them back at like 30, 31 times earnings. I'm not sure what he sees in the business, or maybe I think the higher sort of percentage scenario that I think actually this is probably what had happened is this coincided with his GE purchases, which he's up roughly triple on GE. So if we pull this up, I think what had actually happened is he was using the Microsoft funds to buy into GE, which, GE over the past 2 years has gone up, I think 200-300%, give or take, something ridiculous. And obviously that's been a massive winner for his portfolio. But still, it's interesting because he sold very low on Microsoft, and now after he's made his money with GE and that type of stuff, he's maybe brought in some new assets under management into the portfolio. He's seeing value in Microsoft, and I plan on doing a video on this soon, but I'm thinking of kind of swapping my Salesforce position, like straight up just into Microsoft. And I actually did a Twitter post on this right here. I'll link it in the description if you guys are interested. Basically, it trades at the same multiple, but Microsoft is a better business, higher quality business, more diverse revenues, and it grows faster. Seems like a no-brainer. But again, I'll do like a detailed video kind of with my thoughts about that. By the way, my portfolio is pinned at the top of my Twitter page always, if you're kind of interested in seeing that. But yeah, just very interesting observation that I kind of noticed. Moving on, Terry Smith. Terry Smith is a bit of a weird one for me because I've kind of lost love for him and his portfolio. He was sort of one of the first super investors that I very much admired. Over the period of like 2-3 weeks, I listened to every single one of his shareholder meetings. I read his book. I read his shareholder letters and everything. Just very much fell into his business process. And I still kind of have it of buy good companies, ideally at a reasonable price, and do nothing, right? And the reason I sort of dislike him as of recent, maybe I shouldn't say dislike him, but I dislike his approach is because I think he's a little bit disingenuous. I think he's not really following his own strategy of buying good companies and doing nothing. He's in fact been doing a lot. You know what I mean? Like he's constantly just trimming and selling out of positions, and particularly he sold Amazon at like $80, $90 a share. We could kind of pull this up. Or actually Intuit. Intuit's another one, right? So he's, in 2021 and late 2022 when Intuit was like $200-$300 a share, he sold it. And Intuit is up over double since then. Or Adobe's another scenario where it's up, close to double. I think, how's his history with Google? No, so he's been buying more Google, if anything. Let's try to find Amazon. Here we go. Amazon. Yeah, so he sold Amazon Q1 2023. When it was around $90 a share. That's when he sold Amazon. Sorry, my face cam's blocking it here. He sold at around $90 a share. And then in his investor letter at the end of 2024, I want to say, or 2023, he writes, yeah, the reason we underperformed was because the bulk of the S&P's returns came from tech companies. Although we own some tech companies, such as Meta and Microsoft, our underexposure to tech companies resulted in us underperforming, kind of bad-mouthing, the tech companies. Well, the issue is you owned the tech companies. It's just you chose to sell them at trough earnings. You sold Amazon when it was trading at $80, $90 a share. You sold Intuit at like $300 a share. Same thing with Adobe. Same thing with a couple other, I think, tech companies as well, right? So I've kind of had like a bad sort of impression on him for the past handful of quarters. And, this quarter largely remains the same. He's trimming long-time winners in Microsoft, even though it's at pretty attractive prices, as we just covered. Chris Hohn thinks so. I think it's falling into like a better range in terms of valuation. Definitely don't think it's like cheap per se, but I don't think it's particularly expensive either, right? Trimming a little bit off of Meta, trimming Visa for some reason, which again, I don't think it's like particularly like overly expensive. And so overall, I'm kind of upset with him of not following his strategy of buy good companies and just do nothing, right? Whether it gets like overly expensive or whatever the case may be, like it doesn't ultimately matter at the end of the day. Like your goal here is to just hold them. You know what I mean? So he's not really following his strategy there. Moving on, the two big boys, and we'll do Dev Kantesaria first, because my God, did this make kind of a scuffle over on Twitter. So we were expecting for him to continue to buy ASML, which ASML, it's my most popular video on the channel ever. Such a fantastic business. Just genuinely, like, you kind of look at the physics of it and you have these very much professional people talk about it and that type of stuff. It's just mind-bending levels of physics that occur with this business. And so he had bought a starter position at, I think, about $700 a share all the way back here. And so actually, let me just double check this. So with new buy in Q2 2023, so the quarter end price was about $725 a share. And so he hadn't bought until recently. I think last quarter, he finally doubled his position in it. Here we go. Yeah, he finally doubled the position. And he had bought at a higher price, around the quarter end price at least was around $830. And actually, that was the lowest point in that entire quarter. It was about $830. And so obviously, if you've been following ASML, the stock price has actually declined. It's right now, I think it's like 700 something. At one point, it was about 650, like maybe a couple of weeks ago even. And so naturally, you would expect that this was a washer position that he had built up, over a year and a half ago. He had patiently waited. The stock went above 1,000. And so when it came down to a reasonable valuation, he bumped it up to, I think, like 3-4% of the portfolio. Naturally, one would conclude that because the stock had declined, he would continue to sort of buy into the business. But no, he didn't. He did nothing. So ASML just kept his position that he already had in the business, and that's it. Which, I saw some people who shall not be named over on Twitter are talking about like, oh, I guarantee he didn't buy this and that. He's for sure going to sell out within 2 quarters. Panicking, right? Like almost as if they bought into this wonderful business purely off the borrowed conviction that Dev Kantesaria bought into it, so it must be a good business, whatever the case is. If he's invested in it, I should be invested. Just absolutely ridiculous. Like, do you not build your own conviction? And me personally, I'm not touching nothing. Dev Kantesaria could sell tomorrow. He could go on Twitter and say, hey, I sold ASML. I don't think it's going to do as good in the future. I wouldn't bat an eye. I would continue to hold the business because I personally built my own conviction in the company, and I think it's still a phenomenal business to continue to hold for the long term. No problem. With that being said, he did buy into 2 other companies. He bought into Equifax. Which is the credit rating agency, and then MSCI, which is the index company. I've done videos on MSCI in the past, which I'll link in the description if you're interested in. I did I think honestly, I've watched the other videos, right? Out of everything on YouTube in terms of analyzing the moat of MSCI, what do they actually do? Why is it a powerful business? This video I linked in the description. It's by far the best. It kind of explains sort of the relationship there between the index company and the asset managers and so on and so forth. Again, linked in the description. And then in terms of Equifax, this is the company that he actually used to own in the past in 2019, I want to say, or 2017, 2018. And so he bought into it, and he's talked about it in interviews. He bought into Equifax, and as he was analyzing it, he realized the real power play is actually FICO. And so he bought into FICO a little bit later in the sort of ensuing, call it year after he bought into Equifax briefly and then sold Equifax in favor of FICO. And, the rest is history. He's, I think, up. Let's actually check. Q2 2018, right? Let's take a peek of at what prices was he buying Equifax, or FICO. So his initial buy in FICO was at $193 per share. FICO recently hit, I think, $2,500 per share, but then it's down a little bit. It's around $2,000 a share. So it's a 10 bagger in about 6 years. That is absolutely ridiculous in terms of just pure performance with this gentleman here. But anyways, I digress. So it looks like he, again, bought into Equifax recently. It's a strong business. My only issue is it's a little bit more on the slower growing side of things, and I don't necessarily like that for me personally. I think it definitely fits his mold of buying a quality business, holding it for the long term, long secular tailwind, massive pricing power, right? If Equifax asks you to pay $60 for your credit report, you have no other option. You're going to cough up the $60. If they say 70, 80, you're not going to bat an eye. Realistically, if you're buying a house worth $500, $600, $1 million, whatever the case is, $60, $70, $200, $500 here and there, it doesn't really, as a percentage, it doesn't make too much of a difference. And especially you're paying your real estate agent 10, 20, 30,000 to make that purchase for you. So even if the credit report was in theory a couple $100, which it isn't at the moment, but even if it was, it's negligible compared to the total cost of the closing costs associated with buying a home. So definitely a very strong company. It just grows too slowly for me. MSCI, solid business. Again, over on the Twitter, I kind of recently tweeted a little bit about this post in particular of it's a very strong business because the subscription side of things, which makes up, I think, about 75% of the revenues of the company, they kind of balance out the other component of the business, which is massively cyclical, the asset-based fees related directly to the inflows and outflows of ETFs, which are very variable depending on, if the market is hot or not. But yeah, I definitely think MSCI is also a strong company. Oh, notable trim in Intuit, which very interesting because, Intuit wasn't that expensively priced. It's around $600 a share. At one point it was trading at, let's pull it up. I don't want to talk without the numbers, but yeah, at one point, it was higher, around seven over here. It was about $700 a share. And on a price to sales basis, it was about twice as expensive, right? So I don't think Intuit is particularly expensive here. At the same time, I don't think it's cheap, but very interesting that just now he's decided to sort of trim on that company. And then last but not least, we'll take a look at Polen Capital. Again, very similar in terms of, oh, that's not what we're looking for. Very similar in terms of my critique towards Terry Smith. I share the same sort of critique with Polen Capital because these people that are managing this fund, first of all, massive fund, $40 billion fund, but the issue is the activity, and it's way too much activity. You look across the board here, it's just consistent selling and buying back in. And for example, let's just look at, I think Amazon would be a decent sort of example of this. On a quarterly basis, one quarter, they're selling a little bit, they trim a little bit and then they buy a little bit, trim. Or like maybe let's look at, for example, like I think Microsoft might actually be a better gauge of this. Yeah, like look at their history since 2017. On any given quarter, they're buying a little bit, selling a little bit, buying a little bit more, selling a good chunk. Over the next couple quarters, they ramp it up a little bit more, cut it in half for some reason. Like, what is even going on? And then continued selling for like 2 years straight. Keep in mind, Microsoft stock is consistently going down over this period right here, and they're consistently selling. For some reason, after the stock is up, I don't know, 40, 50% in late 2023, they bump it up. And then again, as the stock continues to race up, they continue to sell it a little bit more. So like, it's just like, this is, by the way, not just with Microsoft. Every single holding in these people's fund on a consistent basis, they're buying, selling. That's just, it doesn't make sense to me. I think for the sort of strategy, I guess, that they're chasing, like, I guess it makes sense. But in my opinion, it would just be much simpler to just, for example, with Microsoft, just hold on to it and buy back on dips. You don't need to consistently be buying and selling into this. The only, I guess with this scenario, I think they had a lot of investors pull out their money into the fund. The only sort of notable ads, I would say Oracle, which has done wonderfully over the past year. So kudos to them. But at the same time, like, you're selling a lot of these companies and they continue to race higher. Most notably in Amazon. Like Amazon over the past year, they've consistently sold it, even though like it's their top position. What's the gentleman's name? Dan Davidowitz. I'm not sure how to, Davidowitz, this guy. So he's the head of Polen Capital's. He's the portfolio manager, right? And he went on to an interview a while back, and he's talking about so fondly of Amazon. Yeah, we think it's our top pick because we see the most upside in it, this and that. Absolutely, I also see the most upside in it. That's why, again, if we go back to my Twitter, you'll see it's been my biggest holding for as long as I could remember, right? So I also see the same thing they see in Amazon. But look, I just don't understand the activity of it. That's my biggest critique with the way that they're running Poland's fund. And then also, like, I guess there's way too many holdings, but these are all like quality businesses in my opinion. So overall, pretty positive, better than like most hedge fund managers, but still very questionable the sort of turnover that they have on an annual basis. I don't like it. Now, with that being said, the last thing I kind of wanted to cover in today's video, of course, has to do with Bill Ackman and his purchase into Uber. Before we do that, I'm going to brag a little bit, because if you go back literally 4 weeks, the sentiment in the investment sphere with everybody on Twitter, YouTube comments, well, maybe not so much YouTube comments, but definitely on Twitter, because that's just the Elon Musk echo chamber, let's just say, right? Everybody is Elon fanboy over there. And the sentiment with Uber was that it is like Blockbuster. I swear to God, people left these comments with under my post. It's Blockbuster in 2007. When Netflix came along. It is BlackBerry when Apple came out. It's Nokia when Apple came out with their thing. It is this and that when this thing came in. It's like buying Kodak before the digital camera or whatever, when the digital camera came. That was the sentiment towards Uber. And listen, it's a very, very fun narrative to say this big company that everybody knows that, we're so accustomed to. It's a very fun game to say this big company is going to get disrupted because XYZ has came along and is miraculously overnight going to take them to zero. It's a fun game to play. The issue with that game is that many times, this goes back to the quote which says people overestimate what could happen in the short term and underestimate what can happen in the long term. Completely applies to this scenario. People are overestimating the fact that Elon Musk and his Tesla robotaxi app that doesn't exist other than a couple, Canva pictures that they've decided to make up and slap over their investor presentation, they're going to miraculously shift 170 million monthly active users' behavior over to the Tesla app simply because they're miraculously going to solve this technology tomorrow, reach all these people, and somehow make the unit economics be less than what Uber is today across, 70 countries, 10,000 cities. They're going to somehow have the infrastructure for that, the charging, the cleaning, fleet management, returning lost items, all these miscellaneous things that Uber handles and has figured out over the past 15 years. They're just going to figure it out. They're just going to figure it out over the next quarter. Yeah, definitely. Seems legit, right? Just ridiculous stuff. Anyways, I would suggest you kind of go back. I think this video in particular, I talked about it. This video in particular, towards the end, I talked about it. Other than that, I had a podcast appearance on Cash Flow Kings. Let's take a look. Here we go. And I would recommend, I think from like the 26-minute mark onwards, you guys kind of take a look into this. This is when I really started to dive into the qualitative aspects of Uber essentially why it's not going to be disrupted. It's nonsense, right? I'll link this in the description as well, just so you guys have it. But yeah, from like the 26-ish minute mark, I think probably for the next like 20, 25 minutes, we really hit on the fundamentals of it and that type of stuff, right? Going back to it, in terms of Bill Ackman and this thesis, it's very much similar things, or straight up the exact same things that I've been talking about. And this is as of the stock price, $79, that he has this opinion of. By the way, I still think Uber is very undervalued, and so we'll go take a look at the valuation and the growth and that type of stuff after we hit on this. But he says it's the world's leading rideshare, mobility, and delivery marketplace, and it's the biggest in terms of both of them combined, right? Definitely not a secret there. Uber's business model has strong network effects that reinforce supply and demand growth. There's 170 million monthly customers and 8 million monthly drivers, or 8 million registered drivers across 70 countries, right? So it's a just remarkable scale in terms of just the sheer amount of people that are using this app, the sheer amount of countries that have adopted this technology, so on and so forth. And here's really the key to Uber, right? So people kind of look at it of like, yeah, network effect, big deal, whatever. Like, what's so special about that, right? But the appreciation needs to be in terms of utilization, right? So the massive amount of demand on the platform, which demand just simply refers to customers, right? The 170 million monthly actives. It drives massive utilization rate for the drivers on the network, because it's a two-sided network effect. At the end of the day, you have your drivers, you have your customers that both need to be happy. So you need to offer a pretty fair price point where you're going to have a lot of customers, but at the same time, offer a price point where it's competitive enough for those drivers, for it to make financial sense for them to continue driving for Uber, right? And actually, the way you do that, and I talked about this in the podcast that I did with the Cash Flow Kings, but I was talking about it. I was like, in theory, if you get 100% utilization rate, meaning as soon as a driver is done, dropping somebody off, instantly they have another person to drive. If that was the case for every single driver across the Uber network, on average, the Uber driver would be making about $30 an hour, which is a very, very fair wage for, essentially just being a taxi driver, right? When the minimum wage in, I think, most parts of America is about 15, you're making about double minimum wage if you're able to drive 100% of the time when you're on the network, which the issue with that is, no, you're not going to have a 100% utilization rate. Actually, the part where it kind of isn't appealing to Uber drivers is you get to sit around a little bit and waiting for the rides and that type of stuff. That's the issue with Uber ultimately, right? So the thing is that over time, as they scale and be bigger and become they have become the de facto almost monopoly, at least for their top 10 markets, the most established first world markets, they have the most amount of scale. The drivers will be inclined to tap into the Uber network and benefit from that scale. Because again, like as a driver, you're not going to go drive for Lyft only if you're sitting there and only 30% of your time that you're spending like of your working hours, only 30% of your time you're actually able to get a ride. You would rather go with the Uber network, and when you're with the Uber network, 70% of the time you're driving. And so as a driver, that's a way more appealing package. And then on the flip side, as a rider, because there's 8 million drivers on the Uber network, because again, it's the most appealing package to those drivers, that brings down ETAs, right? Expected time of arrival goes down. For a fact, unless you're living in the middle of nowhere, if you load up the Uber app, within 3 to 5 minutes, you'll have an Uber ride, right? Guaranteed. Doesn't matter wherever you are, even including in suburbs and that type of stuff, right? Same thing goes with prices, right? As Uber scales, they could optimize the routing and the prices and all that type of stuff and make it the most efficient for the consumers. And then on the flip side, if there's a demand surge in a certain area, they increase the price for the consumers, but then on top of that, they add multipliers for the Uber drivers, right? So as an Uber driver, sometimes if you go on the app, you'll see that like, oh, there's a 2.3 times multiplier, meaning I'll get paid 2.3 times higher if I go to this area 20, 30 minutes away because there's a demand surge, there's a Taylor Swift concert, so on and so forth, right? Whatever the case may be. Or like downtown when it's a Friday night, people are trying to drive back from the clubs and that type of stuff and go home, there might be a demand surge, there might be extra multipliers, so on and so forth. And so this is what he talks about, right? Large demand increases driver utilization, larger driver supply decreases wait times and user prices. That's the spinning sort of flywheel and the brilliance of a network effect. It just keeps snowballing out of control. The same thing kind of happens with Meta's network effects, but that'll be a whole nother 10-minute explanation we won't get into. Anyways, says gross bookings, which is just the trip value. So, when you pay $10, that's the exchange of the $10 there. Of course, Uber only makes about $2 out of every $10 transaction. 160 billion split between mobility and delivery. Fast-growing international business accounts for more than half of the bookings. That's actually very key because the North American business is not that good of a business, funnily enough. Industry-leading management team, I 100% agree, led by Dara Khosrowshahi, has vastly improved operational discipline and capital allocation. Again, 100% agree with this. If we go back to FinChat, and I think I have this chart saved somewhere, maybe I don't. It seems I don't. Like if you take a look at this, like with stock-based compensation in particular, like I definitely agree with his notion of they've become more diligent in terms of capital allocation. It has actually declined over the past, like, call it 6 quarters or so. And then it really starts to be apparent, especially if you toggle on the free cash flows. You could see that, like, the difference of the two, stark contrast, whereby free cash flow has consistently gone up. And then you've kind of been able to see, like, there's this, like, nice margin between your free cash flows and your stock-based compensation that has been created. And this is only going to expand further, right? So there's sort of a critique of, like, with Uber, the stock-based comp has been an issue, still kind of an issue. It's eating up about 30% of the free cash flows. I kind of put a blind eye to that because A, it's declining, and B, even if it were to just stay flat, free cash flows are expanding so rapidly that, like, the margin of the two is going to increase over time, over the next, call it, year or so, that, like, it's going to be negligible if you're looking forward a year, 2 years, whatever the case is, right? Like, it's not that big of a deal, right? Like, it is right now, but it's improving, and that's the direction of it should be more important than the absolute value of it today. You know what I mean? So industry-leading management targets imply a 30%, this is very important, imply 30% annual EPS growth over the next several years, driven by mid to high teens revenue growth, robust margin expansion, and share repurchases. Again, like, you guys could go back to that podcast I did. I was basically saying the exact same thing. I was saying, like, a 15, 16% revenue growth rate is, like, absolutely very easily achievable for this business. And, Bill Ackman kind of agrees with this. He thinks a mid to high teens revenue growth is probably likely. And I would agree. I think that's probably going to happen. It's just on a conservative side of things. We projected 15, 16% revenue growth, robust margin expansion. Absolutely. And then, of course, he looks at it on a PE basis. I look at it on a free cash flow basis. At the end of the day, we both kind of arrive at the same thing. About 30 times free cash flow, about a 30 PE. It's going to grow free cash flow or EPS at about 30% over the next handful of years, right? So we kind of look at it the same way. Any way you look at it, the valuation to growth ratio is just remarkable with this business. And then he says here, we believe that the long-term risk of AV, stands for autonomous vehicles, is limited, and estimate that Uber's share price is likely going to more than double over the next 3 to 4 years. More than double. Would completely agree. So, by the way, stock price is $79 a share, more than double in the next 3 to 4 years. So you're looking at $160 stock over the next 3 to 4 years. That implies about a low 20 to about 30% per year stock CAGR, based off of their opinion. And so there's a lot more slides down here. I'm not going to cover all of them just because I think we'd be, coming up on over an hour here. Well, hour on the recording. I don't know how much of this I'm going to cut down. But anyways, this is probably the more important side of things, where he talks about Uber's a high-quality business which is positioned for rapid earnings growth over the medium term based on strong revenue and operating leverage. Completely agree. Leading global two-sided marketplace with strong and growing network effects, ingrained consumer behaviors driving expanded user. This is, man, I talk about this all the time. So Uber's future growth, which people are like, oh, how are you projecting 15% revenue growth? It's not purely dependent on, just increased users and that type of stuff. It's both bringing on new users to the platform, but at the same time, increasing the average frequency of these users. And on FinChat, we have both of these KPIs. So we have, monthly active customers. And then this is Uber's naming, by the way, which is just so bad. But anyways, this is essentially frequency, right? So, and we'll flow this down to a sort of quarterly view. And you'll see that, actually, I'm going to zoom this in a little bit more. You'll see that over the past, give or take 4 or 5 years or so, the frequency of Uber, so just purely like the average number of rides per quarter, has increased 4% per year, right? And then on top of that, you've had about 20% monthly active users growth. If we zoom this in a little bit more, it'll be less. So it's about 16%-ish. If we chuck on percentage change, I'm going to just clean this up a little bit more. So if you chuck on percentage change, you'll see that, like, your monthly actives are growing at about 14% at the moment. So you do, like, just those two combined. You assume take rate stays the same. You do 14% new users coming onto the platform, and then on average, existing users are transacting about 4% more, that lands you at about 17-18% revenue growth, no problem, right? So when Bill Ackman kind of mentions this and talking about the increased frequency usage, and that is such an important piece to this entire thing of its new users and increased frequency. Strong consumer and driver synergies, yeah, that absolutely works as well, right? So from a consumer perspective, having both Uber and Uber Eats, it's in terms of customer acquisition costs, they both kind of interplay together, whereby the easiest way to get new Uber users is to bring them over from Uber Eats and vice versa, right? Same thing goes for drivers, right? So goes back to the utilization thing. If you are a driver today and you're deciding whether to drive for DoorDash, drive for Lyft, or drive for the local equivalent, whatever that may be within whatever country that they're operating in, Uber is by far the most appealing because A, brand value, B, it's by far usually the biggest within that country, unless it's like, a very small market. And then on top of that, like if you're on the Uber app, sometimes they'll offer you eats, sometimes they'll offer you rides, right? And then grocery is kind of getting pushed in there as well. It's very small at the moment, but still nonetheless, it's something extra for some drivers to do over time, right? So the combination of all these different things allows for those drivers to have the highest utilization rate and just adds extra liquidity to the Uber platform. And so, yeah, he mentions the mid to high teens revenue growth driven by new customers and increased frequency of existing consumers, growth in new consumers due to the increased penetration of mature markets, expansion into new geographies, and new product offerings, right? So those new customers that are coming onto the platform, it's a mix of increased penetration in, for example, US, right? There's still a huge amount of people that don't use Uber or Uber Eats. Over time, they're going to kind of trickle in and become, occasional users of Uber. Of course, they're expanding into new countries. At the same time, they're offering new products like grocery and retail and that type of stuff as well. And so this is the one part where actually when I read this, I was like, oh, wow, that makes interesting sense. He says that the operating leverage of Uber, which of course it has operating leverage, it's just an app at the end of the day. It comes from, they have a very solid fixed cost of making the app, and they've already made the app and the investments around that. And then basically everything beyond that point is just employee costs. Once you've built that app, as long as you don't increase the number, and I'm talking about corporate employees, by the way, not Uber employees, because they are sort of operationally profitable, their unit economics are profitable with the actual rides component. As long as they don't grow their employee count, you'll see the sort of exponential free cash flow chart, right? Whereby it does go from a business of losing $5 billion of free cash flow to positive $7 billion in the span of 4 or 5 years, right? So this is the sort of margin that I was talking about of like, quarter after quarter, just massive, massive improvements in profitability. This is where it comes from. It comes from, having large fixed costs and flexing your operating leverage with only 3% annual headcount growth, which is just employee growth. But at the same time, your annual bookings, right? The actual trip value of the Ubers is growing at 20% over the past 5-ish years. And so to kind of finish off this video, I have a Discord server, which you could check out. It should be the top link in the description, I'm pretty sure. But we have very great discussions here. And honestly, I just wanted to share this because I think this is Abyss, a good friend of mine. I'll link his Twitter in the description as well, but very, very smart individual. And he's definitely been writing essays for us, which I do massively appreciate. But he's been writing essays for us over on the Quality Investors Discord server. By the way, it's price locked at $3 forever, which feel free to check it out, but it's only for a limited number of users. Anyways, you get exclusive videos and sort of discussions about stock and that type of stuff. But he sort of wrote about this a while back, and I pinned it here. But he was talking about how Uber falls into the category of companies that people just naturally hate a little bit because they're sort of upset with the product, or there's bad sentiment towards it of they don't pay their drivers, this and that. Or some people deal with price surging of you're trying to get an Uber home downtown, and instead of it being the normal $40, it's $80 just because there's a lot of people requesting rides. That leaves a bad taste in that leaves a bad impression with people. And it makes sense. For example, Netflix, people, somewhat dislike it. Disney, Meta, Google, right? A lot of people sort of had bad experiences with Google, and same thing with Salesforce. A lot of people just generally hate Salesforce because they don't like the software to use it at work. It reminds them of work, and they dislike work in general, right? So he's kind of talking about this of it's not necessarily a popular company with the average person, So as soon as there's any amount of talk of like Tesla's going to disrupt them, people kind of bandwagon on, and just because they hate the company, I've been a victim of this as well, right? Like I hated on Adobe just because I genuinely hate the product as a sort of a user, right? But I'm kind of looking to look past that as an investor and look at the positive lights, right? So as soon as there's any talk of Adobe's getting disrupted, they're screwed, this and that, I'll pile on to that, right? It's just natural human instinct to kind of do that sort of thing. But of course, you should always look to see if the story is actually backed up by the numbers. How feasible is it? And I think my best advice to any of you guys, look at it from a first principles basis. First principles, what would it actually take in order to take Uber's business away today? They would have to solve the technology, they would have to do this, they would have to do that. And I talked about this as well, right? So I think we there's so much post, but I think I'll just read you guys this bit, right? So I said, in summary, it'll be incredibly hard to scale and change user behavior and still come out cheaper than Uber's and do it across all geographies, which is highly localized with different regulations, different state, city, or even airport basis, right? So Uber is, for example, Ubers can't stay at this spot in the airports. And I think Waymo's right now, they don't go to the airports, right? So all these different things is like, again, across 10,000 cities, you have to figure that out. It's massive, massive amounts of scale, which Uber has already figured out. And then you still have to move now it's 170 million monthly actives, provide the necessary supply for them. Again, you need 8 million drivers. It's just really hard to compete with Uber without tapping into their network for instant monetization and scale. Then again, you have the fleet management issues, right? So I think 10 years out, a lot of people are going to figure out the full self-driving technology. And odds are there will be a couple of them that are big enough and have the brand value, for example, the Teslas, the Waymos, that'll do it themselves. But then there will be most AV technology providers that are like, hey, we are not trying to get into a taxi business. Instead, what we want to do is we want to figure out the software side of things, make really high gross margins, tap into the network for instant monetization, and just live off of the fruits of solving this difficult software problem. That's what we want to do. We don't want to deal with all the other low-level garbage work of it, right? The fleet management, the charging, returning products, and that type of stuff. And you'll get a scenario where it looks like a Booking.com or Expedia of today, which, by the way, Dara, the CEO, comes from Expedia, right? So like you'll kind of see the vision of that, of, you know, with Expedia or whatever, like for example, a Marriott or a Hilton will have their own website, but will also, to maximize utilization, goes back to the whole utilization argument, to maximize that, they'll also list on Expedia, because some customers will want to book through Expedia, some customers will want to book through the actual website, right? So I think that's naturally what's going to happen with this market. And I think another thing I'll add is like Elon's promises of getting a 90% market share in AVs. He's not going to be the only one that figures it out. And he's not going to be the only one that figures it out globally. You know, there's a lot of leading Chinese companies that are currently working on this, like Baidu and Alibaba and all these companies, they're working on it. They are very profitable businesses and they have massive incentive to figure it out, because they're going to figure it out within China or within sort of that region of the world. And then at the same time, like you have, for example, Europe. Like you think Europe is going to just hand over, from a regulatory perspective, it's just going to be completely fine with handing Tesla over the keys to this market? No, of course they're going to give them massive amount of trouble to sort of figure that out. And so I think the AV risk is massively overblown. With that being said, I'm going to point you to Brian Feroldi's sort of video. He sold Tesla to buy into Uber, which is just, wow, touche, right? But in his video, he talks about towards the end that it's a 7.5% revenue growth rate baked into Uber stock price for the next 10 years. And I sort of agree with his notion. I think we'll just pull up my own numbers that I kind of built out. And let's see. So they do, I got to change these around a little bit. So they do 6.9 billion in free cash flow. We think we'll just put it at 15% revenue CAGR. And then I think I'm going to bump up the free cash flow margins. I'm going to say 19% free cash flow margin, a little bit more on the aggressive side, right? And so today, actually, you know what? We'll do 18%, right? So these are pretty conservative estimates, okay? Currently, Uber's at like 17% free cash flow margins. In terms of revenue growth, we just looked at it. You're looking at, like 17, 18, 19% revenue growth potentially for the next handful of years. And by the way, these green boxes, I'm not touching them. They're just exactly how it is. Sorry, I need to update the revenue as well. So revenue, they're doing about 44 billion of revenues. So this is our conservative case, right? Uber today trades at a 4% free cash flow yield. And so if we just say that they just stay at the current multiple, which is like pretty cheap, right? For a very fast growing business, a 4% free cash flow yield is quite cheap. If they just stay at the current free cash flow yield, and end up growing pretty conservatively over the next couple of years, you're looking at 23% stock CAGR from today's price. Now, here's the part where it gets interesting, right? If it goes down to a 5% free cash flow yield, like it was, 2-3 weeks ago when it was at $60 a share, you're still looking at a 14% stock CAGR over the next handful of years. This is, by the way, 2024 to 2027 sort of CAGR calculation, right? Now, let's say that things improve a little bit and the sentiment towards Uber changes a little bit. Actually, let's go, it goes to 30 times free cash flow, right? So it's currently at 24 times. It goes to 30 times free cash flow. You're looking at 31% stock CAGR. Now, I'm going to put this back, but then at the same time, let's go a little bit more aggressive with our estimates. Let's do a 17% revenue growth rate, 20% free cash flow margin, pretty aggressive sort of growth. Again, and the multiple doesn't change. You're still looking at a 30% free cash flow CAGR. Let's put that to like, Jesus Christ. Yeah, so and then you bake a little bit of multiple expansion there. All of a sudden, you're almost at 40% per year of stock returns, right? And then you have so much room on the downside in terms of multiple compression or things going wrong or your estimates not really falling through, right? Like maybe they don't grow at 17% revenue CAGR, right? But still, like there's so much margin of safety built into this price. And I kind of agree with Brian Feroldi's notion of like this price currently with Uber, even at $80 a share, this is not baking in that much growth. And so me personally, goes all the way back to my portfolio. I think I'm going to sit tight for now because I have 15% in the company. And like at some point, it just becomes portfolio management of like, for right or wrong, what if this company underperforms over the next couple of years just because of AVs? Or the bigger thing I'm kind of scared at is you don't know what you don't know, right? And maybe deep in Waymo, they're kind of planning on like using Uber to scale up. For example, what Netflix did to Disney of using Disney's content on their platform, scale up, get big, get entrenched in people's homes. And then now Disney has to play catch up in terms of their own streaming service, right? So it's that sort of things that we just don't know today. We don't know what Waymo's thinking. And at some point it becomes portfolio management of like, it's a 15% position, even though I expect it to grow probably faster than everything in my portfolio. Maybe it's better to just sit back and let the gains compound and let that make up a bigger portion of my portfolio. Because let's say I bump it to a 20% position, some gains after a little bit, it's getting closer to Amazon. Even though like I love Uber, the business, I'm not sure I'd be comfortable holding 30% Uber. Right? You know what I mean? For any given reason, if Elon Musk puts out a tweet, it shoots down 10-20%. I've just lost thousands and thousands of dollars. I don't know if I'd have the stomach for that type of thing, right? Just off of an Elon Musk tweet being at the mercy of his thing, right? Like it would hurt me psychologically. And so that's why I'm probably gonna sort of like relax in terms of continuing to add to this position. On the other hand, I am thinking of just outright selling Salesforce for Microsoft to add a little bit more stability to the portfolio. So with that being said, to kind of close out the video, there's two ways which you could support me. The first one, actually, we've been using the website and the software all video long. I personally work for the company and I think it's the best stock research platform in the world. The great news is you can actually get 2 weeks of FinChat Pro completely for free. So it's our highest tier full functionality version of the website and is valued at about $80 a month, right? So this is American dollars, by the way. And you could try it out completely for free for 2 weeks. Brilliant charting interface. We have segments and KPIs like you guys saw. We have investor, super investor pages, so on and so forth. Again, top link in the description. And then the second way, which you could actually kind of discuss things with me and be a part of the sort of community, $3 a month forever over on the Patreon. I'm not really trying to price gauge anyone with this. If you go back to the original video where I talked about this, I just want it to be sort of a barrier to entry so we don't just get anybody in there. And so again, we're having a lot of fun over there, having a lot of great discussions. So far, the community has been a great group of people, so on and so forth. I post exclusive videos on there as well. Ask me anything, monthly votes in terms of which stock to analyze and so on and so forth. Anyhow, if you're interested, this one has a free trial as well, by the way. So there you go. You could join for 7 days. If you don't like the Discord server, feel free to leave. No hard feelings, right? Anyways, thank you for watching this. An hour, well, it might be shorter, but an hour and 10 minutes into the recording. Thank you very much. Have a great day.